Alright guys, welcome to Trading Transformation day number 20. I think it's 20. But anyways, as you guys know, we talked about equilibrium yesterday. Talked about what it is, how it helps us. So today, we're going to talk about literally the easiest confluence ever to be able to identify. So this should be relatively quick. And again, I'm not teaching you guys how to enter yet. We're super close. Next up is breakers. And then after that, we can put everything together. And I can spend like hours showing you guys how to put stuff together. Okay? But for now, we're talking about equilibrium and how to identify it on the chart. So, like I was saying yesterday, we identify it with a swing, from a swing low to a swing high, or from a swing high down to a swing low. Okay? 谢谢不要。你好，是你的名字。Oh, God. Okay. Wow. I am sorry. Moving forward, we identify it from a swing low to a swing high within an uptrend. Within a downtrend, we take it from the swing high down to the swing low. And you're probably asking, oh, you, the handsome boy in the front? No, not the one that I'm pointing at. That one. What, mister, what's a swing high? What's a swing low? I'm gonna tell you. It's literally just the higher high and the higher low within the uptrend. So if we think about okay, that was horrible. Let's redraw this and be normal. Beautiful. The best uptrend I've ever drove in my entire lives. In an uptrend, we take it from the low up to the high. Okay, so we want to be able to find the discounted price, right? Because we know that equilibrium is identifying premium price and discounted price. And why is that beneficial to us? Because if we see price go into a discount, and then within an uptrend, if we see buying power come out of that discount, we can assume, okay, buy orders were filled because it was at a discounted price and price is going to continue higher. Okay, wow, that was so hard. That was so smart. Okay, now, how do we identify this? I use the GAN box. Okay, and it's literally identified by the 50% mark, or the halfway point, from the swing low to the swing high. Okay, so we take it from the low and just drag it, boom, up to the high. And as we can see, my perfectly drawn down uptrend dipped perfectly into our discounted price, which is underneath here, right? Because anything up here would be premium, and anything down here is a discount. Everything up here is a premium. Why? Because it's higher prices, and we're in an uptrend, and we're looking to buy. So as price goes lower, it's cheaper for us to buy, okay? So everything underneath the halfway point from the swing low to the swing high is going to be a discount, okay? We see price come into the discount, we see buying power come out, price continues higher, okay? Boom, let's do it again. From the low to the high, we see price, boom, come down, again, perfectly drawn uptrend. We come right into the discount, we see buying power come out, price goes higher. Last time on our beautifully drawn uptrend, okay, we take it from the low up to the high, price again, perfectly comes into our discounted price range. We see buying power come out, price continues higher. Okay, now let's talk about it in a downtrend. Let's see if I can drive this one as good as I drove the other one. It's already worse. Let's try again. It's already really bad. It's really bad. That's as good as it's gonna get. Wow, okay, that's better. Okay. In a downtrend, we take it from the swing high, it's literally just the inverse, the swing high down to the swing low. Okay, so boom. We have our game box here. You guys want to see my settings on this? This is what I have my settings on. Take a screenshot, take a picture. You got your pictures? Cool. Okay. We take our game box from the swing high down to the swing low. Perfectly driven downtrend. We see price, boom, from high down to the low. We see price get into the discounted price range, which is now this above area, and this is the premium, right? Because we're trying to short it, so we want to short at a higher price and buy it back at a lower price. Okay, so boom. We see price get into that discounted price range. We see selling power come through and push it lower. Price continues in that direction. Okay, let's keep doing this. And then we'll start going into how to identify it on actual real time. Okay, moving forward. Okay, swing high down to swing low. Price pushes up into the discounted price range. We see selling power push out. Price continues lower. Okay. One more time, swing high, down to the swing low. We see price push into the discounted price range. We see selling power come out. Price continues lower. Okay, and again, this is similar to fair value gaps, similar to order blocks. It is a continuation confluence. So does price require this to happen to move? When we're within a trend, does price have to go into that discount? No, but if it does, it's a higher confluence for us to assume that price is going to continue higher. So if we look at this as like an uptrend, we see boom, this is the high, this is the low, okay? And then from here, we want it here. We see this is the low, okay, because we take it from swing low to swing high, and then we see this high get made. There's going to be times where you see like a little pip squeak of a low get made, and you're probably thinking, hey, it never came underneath equilibrium. And that's okay, because sometimes the market moves and doesn't hit our confluences. And you just have to accept that, okay? But for the next swing low to swing high, we can see, oh, it did go into a discount, and we did see buying power out of it. So price is probably going to continue higher, okay? And that's how we have to treat it. Okay, so now let's do this super simply, super duper easy. We'll find examples of this within every single time frame and every single trend. Okay, and we'll just go and show how this works. So boom, we're in a downtrend. How do we know that? Move down, then a move up. We find the lowest point of those two candles right here. We see breaking structure to the downside. Cool. We're in a downtrend. We take it from the swing high, move up, move down, highest point of those two candles. To the swing low, move down, then a move up. We take it to the lowest point of those two candles. Okay, let me just extend this. Oops. Okay, what do we see? We see price push up into a discounted price point. We see selling power come out, price moves lower. Okay, same thing, swing high, down to swing low. We see price push on up in there, right? We see the move up, then we see price continue lower. Okay, now we get a breaking structure to the upside. Now we're in an uptrend. Okay, we take a swing low to the swing high. We see price, boom, come into the discounted price range. Buying power out, price continues higher. Let's go into a smaller time frame and identify this. And again, it's not going to happen every single time. Let's do this on like the weekly, actually. Okay, we get a break of structure to the upside right here. Boom, we're in an uptrend. Take it from the swing low, move down, then a move up. Boom, to the swing high, move up, then a move down. Boom, we see price poke into the discount, buying power out, price continues higher. Okay, let's try and find another example of this. Right here, we're in a downtrend, we break structure to the downside. Swing high, down to swing low. We see price, boom, push up into equilibrium, selling power out of it, price continues lower for a bit. Okay, and this is all it is. It's just helping us when price is retracing down. It just helps us say, hey, it's the same thing with order blocks, it's the same thing with fair value gaps, it's the same thing with breaker blocks, it's the same thing with equilibrium. What do these continuation confluences help us? They help us identify areas where if we see buying power or selling power out of them, that if those areas get hit and we see buying power and selling power out of them, then we can safely assume that those were good confluences, that more orders were filled, and price is going to continue in the direction that it wanted to go in. Versus something like this, if it's in like an uptrend, like, I don't freaking know, something like that, right? Like, and let's say there's no fair value gaps, no order blocks, and it's just like the tiniest little moves down, right? Like, we probably don't want to be entering on that. When do we want to be entering? When we know the market is filling more orders. And we know that it's a high probability area where more orders can have the possibility to be filled, and then we wait for confluences out of those high probability areas. What are our high probability areas? Order blocks, breaker blocks, fair value gaps, and equilibrium. And all that we're doing with those is identifying them on the chart when price retraces, and if it goes into those price ranges and we see buying power or selling power out of it, depending on the trend, we can safely assume that price is going to likely continue in the direction that it was going. Cool? Cool. Awesome. That wraps up equilibrium. Part 2, we have breaker blocks, and then it's time to get serious, and then we're going to start putting things together. All right, boys? I appreciate you guys. We'll see you guys in the next one. Peace out.